Hello, everyone. My name is Chris Johnsen, and I am a business lawyer and entrepreneur. At Johnsen Law, we handle estate planning, tax planning, and asset protection, among other practice areas. Periodically, I get people come to me and they see something on Instagram or TikTok, and it's a video with some guy or some gal claiming that they have this trust, this mechanism that everyone's missing out on, the secret to the wealthy that only the wealthy are using and no one else knows but them. And they only have to pay a very minimal amount of taxes. One of my friends and clients came to me with one such thing and came to me with an hour-long video from an attorney friend of hers talking in detail about this trust structure. And then also submitted some marketing materials that claimed that these materials were compliant with the law. And it still just didn't seem right. And what I want to talk to today is about an IRS ruling. Because look, don't believe me, don't believe them. But here's the thing, you can't argue with what the IRS says. I'm talking about something that has multiple names. Just because you hear one of these words doesn't mean that trust you're looking at right now is what I'm talking about. I'm talking about something that has one of these names, but that's purporting to shelter income. The most common thing I've heard is a non-grantor, irrevocable, complex, discretionary spendthrift trust. Wow, what a mouthful. I've also heard that by the initials NICDST or decent, DSCINT. I've also seen it as a capital gains deferred trust, a complex trust, spendthrift trust, business trust, the super vehicle. I've also seen the 5-point trust, and I've also seen the copyright trust. When you dive down into these things, dig in, oftentimes these people are really talking about the same thing, and that's that non-grantor, irrevocable, complex, discretionary, spendthrift trust that's being marketed. And I've taken snippets directly from the IRS opinion, and in the comments of this video, I will include the link to the actual IRS opinion, because I want you to see it for yourself. I don't want you to feel like I'm ad-libbing here or adding anything. So here's the claim. Income earned by the trust. The promotional materials claim that almost none of the income generated by the trust is subject to current federal income tax if the trustee allocates such income to corpus and refrains from making distributions to beneficiaries. The legal basis for these assertions regarding federal income taxation rely on 643 of the code. I'm going to try to keep this simple. I know that was really a mouthful. So look, essentially, you could avoid paying a large portion of income taxes as long as you just, per this agreement, allocate things according to 643. Okay. So here's the IRS's opinion. If a trust excludes all capital gains and extraordinary dividends from income within the meaning of 643, that simply means that the trust will subtract those capital gains and extraordinary dividends from DNI under 643. I'll get into what DNI is, so long as those amounts are not actually distributed to the beneficiaries. In turn, subtracting those amounts from DI simply means that trust has a lower threshold for the deduction that it can take for distributions to beneficiaries authorized by 651. Here's the key that I've highlighted. If a non-grantor trust does not make and is not required to make any distributions to its beneficiaries, which they don't under this scheme, then it is not entitled to any income distribution deduction. Therefore, all of the income attributable to capital gains and extraordinary dividends must be reported by the non-grantor trust as income on Form 1041, meaning they got to pay taxes on that income. Now look, it says capital gains and extraordinary dividends. And a lot of these materials, and as you'll see later in this, they point to some provision that says extraordinary dividends are excluded and you don't have to pay taxes on it. The IRS is saying, no, that is absolutely not true if this trust doesn't make any distributions to the beneficiaries. And like I said before, the whole purpose of this thing is to keep the income in this trust and magically not pay any taxes on this income. So what is 643? It's IRC, Internal Revenue Code, section 643. And these promotional materials, the people that are advocating for this, and do some searches online. Go on YouTube, go online. You're going to see a bunch of presentations, and they're going to go through these provisions, arguing why it does what the IRS says it doesn't do. So let's look at A3. And the IRS says to support the assertion that all income from the sale or exchange of capital assets, i.e. capital gains, is excluded from federal income tax, the materials, quote, 643A3. So here it is. IRC, section 643A3, capital gains and losses. Gains from the sale or exchange of capital assets shall be excluded, and this was emphasis in the original materials, to the extent that such gains are allocated to corpus and not A, paid, credited, or required to be distributed to any beneficiary during the taxable year. Wow. I mean, it really does. Reading that, it seems like, okay, capital gains are excluded. This is great. You also look at A4. And the IRS says, next, the materials claim that the trustee may characterize any remaining trust income as an extraordinary dividend, which the materials claim is not subject to current taxation so long as the trustee allocates such income to corpus. The materials find support for this claim in 643A4. Here's the quoted language. If a fiduciary has the sole and absolute authority to designate something as extraordinary dividends or taxable stock dividends, and that designation is paid to the corpus of the trust and not subject to distribution, then it is not income to the trust according to Rule 643. Wow. Again, now extraordinary dividends aren't taxable. This seems great. Here's the problem. If you go to the actual statute, 643, and you don't just look at A3 and A4, taken out of context, in a statute that is one of the most complicated, convoluted statutes out there, and you can't take two provisions in isolation. You have to look at the whole statute. You really don't have to look far. If you go to the statute yourself, and I'll provide a link, you really just look to the very beginning before A3 and A4. So let's look at just A. Okay, this is from the IRS again. The promotional materials support their claims about the tax benefits of their structure by reading subsections of 643 out of context, subsections being A3 and A4. The materials do not address 641, which we haven't even seen, which provides the basic rule that the trust taxable income is computed as it is for individuals with certain modifications. Instead, the materials look to 643A for guidance as to the definition of taxable income. In so doing, here's the key. The materials fail to consider the beginning of that section, like I mentioned, which expressly states that the section defines distributable net income rather than taxable income. Okay, so 643A is not even talking about taxable income. You know, the stuff we actually pay taxes on is taxable income. It's talking about this completely new thing in the tax law called distributable net income. That's DNI. And I told you I was going to mention that again. Here's a snippet from the statute. I took this directly from the same link that I'm going to give to you. The heading A is distributable net income. It says for purposes of this part, the term distributable net income means with respect to any taxable year, the taxable income of the estate or trust computed with the following modifications. And then it goes into A3 and A4, which these promoters of this trust take out of context. Back to what the IRS says. Section 643 defines the concept of distributable net income, or DNI, of the trust. DNI not only limits the amount that the trust can deduct for distributions to beneficiaries, but it also determines the amount on which the beneficiaries can be taxed as a result of those distributions. The income distribution deduction of the trust, coupled with the gross income inclusion to beneficiaries, ensures the income of the trust is taxed, here's the key, either to the entity or to the beneficiaries, but not to both. And again, this is a mouthful. Here's what you need to understand from this, the very basic concept. DNI says who pays the taxes, the trust or the beneficiary. That's what DNI does. That's what Section 643 is about. It's not about wiping out taxable income like the promoters of this trust claim. Ouch. Audit recommendation. This is what the IRS in this letter is telling its agents to do. Here's the recommendation. In each case, using this structure as a threshold matter, meaning it's a starting point in all cases, the trust's income tax returns should be examined. What that means is audited. Audit the trust to make sure, A, the trust is reporting all of its taxable income, including capital gains and any income that is described as extraordinary dividend. They want you to pay taxes on that. You can't avoid paying taxes by using this structure. The unfortunate thing is that the promoters out there are charging an arm and a leg. I've seen prices upwards of $50,000. They're targeting people that think, wow, I can save on paying taxes. There must be this loophole that only some people know about. And the reason I'm making this video is because I just think that's wrong. I think it's wrong to take advantage of people. It's wrong to sell somebody a broken product. And in today's day and age with social media and all this information out there, it's really hard to know who to believe. So that's why I'm literally going through this IRS letter so you can see for yourself. Don't take my word for it. Take the IRS's word for it. And they're cracking down on these things. Educate yourself so you don't get sold on something that you buy to not pay taxes or to pay less taxes, and it doesn't work. And here's the unfortunate thing. There's a lot of great strategies to save on taxes. And I'll probably go over those in some other videos. And those are services that we absolutely offer our clients. But this is not one of them.